There are two different styles of investing, passive and active, or indexing and speculating, and both are at the opposite ends of the spectrum. Indexing is a passive, long-term strategy, and speculating is an active strategy aimed at shorter-term gains. In this video, I want to explore the differences between these two strategies. Indexing is investing in a fund that tracks an entire market, like for example the FTSE 100 or the S&P 500. It is the opposite of forecasting or trying to predict the future by betting on a particular stock, fund or opportunity. The problem with forecasting is that although many people claim otherwise, no one can really do it successfully and keep doing it. Nobody ever sees any big global depression or 5-year economic cycle come along when markets depreciate by 25%. Indexing is about ignoring the forecasters, staying put and saving as much money on fees as possible, which means it's certainly not about making a lot of trades in your portfolio. Every time you make a trade, it costs you money, and all of the data and evidence shows that if you just buy and hold, you'll do best. It's about having high levels of diversification in your portfolio. For example, by investing in the UK equity market, the global equity market, and the emerging world equity markets. Being in a broad range of geographic locations and categories like large cap companies, small cap companies, and value cap companies. On the other side of the pendulum, we have the speculators. Speculators would say diversification is just for people who don't know what they're doing, who don't know what stocks and shares and bonds to pick. They are confident they can pick the right investments and often have a very low, or certainly a much lower level of diversification. Now the speculators say it is about forecasting and all they need to do is hold all the really great securities, stocks and bonds and avoid the really bad ones. Simple, right? Not exactly. If it was that easy, the reports would suggest otherwise. It is my belief that if you're on the indexing side of the pendulum, you'll have a successful experience. I'm not saying you won't as a speculator, but all of the research and evidence from the University of London, Cass Business School suggests that in around 80% of cases, you'd be better off indexing, keeping costs low, and just strapping in for the ride. I joined Barclays in 1989 and I spent 9 years in the retail bank before moving into asset management. Between 1998 and 2002, I was responsible for investing over £20 million of clients' money for the bank. So I've been in this world for quite a long time. With speculating, you have to keep getting it right, and it can cost a ton of money if you get it wrong. So I'm unapologetically on the side of indexing. The real issue begins when you start to look at the fees associated with active management, which I'll be covering in my next video.